Hi, I'm Dr. Kevin Milo, one of the co-hosts of the Physician Empowerment Podcast. At Physician Empowerment, we're dedicated to improving the lives of Canadian physicians, personally, professionally, and financially. If you're loving what you're listening to, let us know. We always want to hear your feedback. Connect with us. If you want to go further, we've got outstanding programming both in person and online. So look us up. But regardless, we hope you really enjoy this episode. Hi, everyone. I'm Kevin Milo with Physician Empowerment. And joining us tonight is an outstanding guest and a true expert in her field. And I want to make sure I get these introductions right because there is so much she has achieved. And I actually came across Cherry Chan through one of her books. So she is a published author and one of Canada's leading experts in real estate taxation. She's an entrepreneur, an accountant by training, just a phenomenal mind in this space of real estate investing, taxation, long-term tax strategy. And so we are very, very glad to have her here. And tonight's topic is extremely relevant to all of us, and that is the 2024 federal budget. So Wing and Cherry are going to be going through this and unpacking it this evening, and we'll have an opportunity to explore this in more depth as well at our conference later in the month of May. And again, super excited because Cherry is going to be speaking at the conference as well. We are so glad to have you joining us this evening, Cherry. And let me hand it over to you to speak a little bit further.
Well, okay, thank you, Kevin, and welcome everyone to this very, very exciting and timely episode that we have just for you guys, for everyone, right? So let me do a little backdrop, and then Cherry and I would dive into the conversation. So you guys all heard it, right? You know, our Prime Minister Trudeau handed out $500 million, $1 billion, $500 million, all these new incentives to the working poor, right? And these all social programs that is going to help everyone. And then he says, who's going to pay, right? And it's just somebody's got to pay, right? And then so sure enough, April 17th, you can see that photo with Trudeau and Freeland, right? They're standing together, making an announcement and say the rich is going to pay, right? So the rich is going to pay. And the rich is only very few, like 0.1% of Canadians would be affected. And so, of course, there are a lot of changes that we're going to dive into, but I just want to bring some stats when we talk about this capital gains inclusion rate elevation, right? And so the rich is going to pay, right? And then they say, hey, this only affects the rich. So I was listening to tons of podcasts, and there's some facts that I listened to the CIBC gang when they dissect this and they pull up the 2021 federal stats, right? So apparently in 2021, 30 million tax files were submitted, right? So 30 million tax files. And half of the Canadians that submitted, 60% of them make $50,000. 13% of Canadians that filed the tax made more than 100K a year, 100,000. A percent of them made more than $250,000 a year. So if you say the rich really got it unfair because they pay too little tax because the working poor paid it all. And Freeland said that if you have a nurse or you're a plumber or farmer, I forgot what she said, at this moment, you can pay more tax than the super rich, but we're going to change that, right? So interestingly, these are stats that you can pull yourself, right? So the 100K and above, so 13% of the Canadian that made 100K a year, they earn 42% of the income, but they contributed 62% of all the taxes, okay? And the people the rich, the more than 250,000, which is most physicians here and dentists and whoever. Congratulations, you guys. You contributed 29.4% of all Canadian taxes. 1% of Canadian would contribute almost 30%. So there you go with the rich being, just being a slacker, not paying their way, right? So let's dive right into it. And of course, Chair, I think you are just as shocked as everybody else in the tax world. Tell us, first of all, how do you guys feel about this announcement?
Oh, I was very, very upset. I don't think anyone who has essentially who's contributing to the Canadian economy and have any type of investment that would not feel upset and disappointed at this particular budget, right? They're painting they're essentially dividing the government, dividing the Canadians among the ultra rich, the way that they paint it, versus what reality, they're really targeting the middle class. They want us to own nothing and be happy.
Right. So then, yes, and I'm shocked at how many of my colleagues that this does not touch them at all, because this is super rich. So unpack this a little bit, right? That how does the middle class get skinned by this proposal or announcement?
So I think the biggest thing is that they have increased the capital gain inclusion rate from 50% to 2/3, 67% roughly. And what it really means is that if you make $100,000 profit from selling stock portfolio, you have accumulated $100,000 capital gain on it. In the past, you only need to pay tax on $50,000. From June 25th onwards, you would have to pay tax on essentially $67,000 of it. And if you are using the top marginal tax rate of 50%, 53% in Ontario, just round it down to 50%, say 50%, then you have to pay more taxes in general. That is a substantial increase. It's about 8% increase in terms of tax, like just on tax alone. But 8% as in, instead of 25%, you're paying 25%, you're now paying 33%. So it's a lot. What people don't understand is that a lot of the people out there who save up their money and invest it in the property. So in my video, I've used my mom as an example. We came here long time ago, 25 years ago. She worked in the garment factory, saving all her money to buy a house. She just did not sell. So she left, she moved back to Hong Kong, and she did not sell that property and kept it as a rental property. And because of that, she didn't sell. And now she's being penalized for not selling. But the decision was made long time ago. She didn't. And at the time when we purchased the property, we weren't expecting a huge increase. We were just hoping that, hey, we won't be kicked out by our landlord. And that's the reason why we bought the property. At the time, my mom was warned by her best friend that there is no appreciation in Canada in the real estate market. Do not buy a house. We chose to buy it just because we wanted a permanent home. And now she chose to keep it because she wanted something to pay for her investment. She's not by any means the top 1%.
So this is not even incorporated individuals. We're talking about the regular Joe, right? And there's this saying, well, it's $250,000 threshold per year. Think about how rich people are, right? Per year, more than $250,000 capital gain. Right. So now you're saying, Sherry, that is not just the ultra rich, just the mom and pop. Right. And so what about us incorporated professionals?
Oh, yeah. So you're kind of like me, on the same page as me. I'm also a professional, also incorporated. So a lot of us take advantage of the incorporation to own our business because the rate is so much lower. The tax rate that we would have to pay within the corporation is 12.2% in Ontario. So that means a lot of us using that 88% profit for investment purpose. If we were choose to invest within that corporation structure, you now have 88 cents on the dollar to invest. So that's the reason why a lot of professionals incorporated their business, accumulated a bunch of money within their corporation, and use the 88 cents on the dollar to purchase investment properties, to buy stock portfolio, do whatever investment that they are doing within the corporation structure. Now with that tax law change, basically Trudeau came out and said, if you own investment in a corporation and you make that capital gain, there is no $250,000 exemption. Immediately, the first dollar that you realize as capital gain, 2/3 of that would be included as your income, taxable income. Whereas if you were to own the same stock portfolio or same rental property in your personal name, you at least would have a $250,000 exclusion or de minimis. Essentially, the first $250,000 of capital gain in your personal name realized would be still going with the old way of calculation. Only 50% of the capital gain would be 50% of the first $250,000 would be taxable. But in the corporation, they say no, even from the first dollar that you make, you're still having to pay tax on the 2/3 of the capital gain that you make.
Right. So this is anybody that is not on a salary, right? So it doesn't matter whether you a wealthy multi-gazillion billionaire that own an empire of corporations, or just somebody that incorporated plumber, right, farmer, doctor, accountant. It doesn't matter, right? Anybody, and you don't even have to make a ton of money. Just any dollar that you make, that you create a capital gain, then you're going to be skinned.
Absolutely. Very disgusting.
And when is this going to kick in?
June 25th.
Okay, so let's get it straight. So April 17th, right? I'm looking at the news. So they gave us, all of us, right, 2 months and 1 week. So 9 weeks to get our acts together, right? And so I've been here long enough, right? I've been in practice for 30 years here. I've lived through quite a few economic cycles and some dynasty changes in Canada. And there's some very significant tax change moments that are of seismic magnitude, right? And so I think this is Richter scale, like 7.8 at least. The last one that we lived through, luckily with some modification, was 2017-18, right? So, like there was actually with Morneau at that time. There was a lot of earth-shattering, dynasty changing, actually intergenerational wealth of farmers would have been wiped out had it not been some resistance, right? So probably lived through that era too, right, Sherry?
Yeah, it was also very frustrating because, again, what I didn't like is that they're singling out professionals and service professionals. So 2017, they essentially remove all these dividend income splitting strategies available for professionals. And it's only eliminated for professionals. And that's what got me really upset. And in this particular budget as well, because they're increasing the capital gain inclusion rate, they're also adjusting the lifetime capital gain exemption on sale of shares for everybody to account for that 2/3 inclusion rate. And coming along with this whole project, whole budget, they have introduced something called an entrepreneur incentive. Essentially, they would give more tax-free money for people who operate their business, found their business, owned it for at least 5 years, and essentially allowing them to even have more tax-free money when they sell the shares of the business. But they specifically, again, exclude professionals, service professional. They exclude also a bunch of other stuff like entertainment and all that, but they again exclude professionals. They take that away. I don't understand what the logic is. It's not like we don't have to take on, I have a team of accountants that I have to feed. It's not like I don't take on the risk. I just don't understand why they have to singling out us as professionals.
Right. So it turns out that we are the rich, I guess, right? Even though we aren't.
Yeah.
Right. So now for our audience who's mostly medical in background. So let me go down the memory lane. Now, I've never been in Ontario practicing, but I was told that our medical association fought with the government in the 80s. Now, I was in med school in the late 80s, and I heard about these things, right? So they were fighting for race, and there was like big smearing campaign, Ontario Medical Association with the government, provincial government, and then at a standstill, and the doctors ready to walk out, and actually us Albertan doctors were ready to walk out a few short years later. We always follow Ontario, right? Anyhow, and so the government said, okay, there's no race. There's no money to boost this, but we'll allow you doctors to have a professional corporation status, MPC, right? And then you can take advantage of all these corporate gains that every other Joe Schmo corporate owners have. And that was the promise, right? That was a promise for us who have a MPC, right? And actually, I gave this talk, this little snippet in one of our CM events in Mexico. And here to tell people that we're going to do one of those next year. And these are audience, all doctors for different ages. And I was, as soon as I finished saying this, one guy raised his hand, and I thought, are you going to correct me? He says, buddy, you said right. I was in that negotiation table. This doctor from Ontario, he was at the OMA table. So this thing is real, and it's not that far away, right? 1991, that's the year I finished medicine. It's not that far away that this whole short phenomenon, and throughout the last few decades, our government, especially our esteemed prime minister, have mentioned one single profession, doctors, mentioned multiple times in public media that doctors had it too good. So yeah, so then, okay, we got 9 weeks to get our affairs together. So Cherry, what do we do?
So one of the things that people are contemplating is to crystallize their capital gain. So remember, up until June 25th, whatever you sell is still following under the old system, essentially only being taxed whatever capital gain that you have, 50% on the dollar, you would be able to pay tax on it. So if you are able to afford it, you want to crystallize your capital gain. So the easiest example that I had is I was talking to a colleague, another accounting firm's owner. He has a client who has accrued about $3 million of capital gain on his stock portfolio. Now, stock portfolio is relatively easy to liquidate, right? So the suggestion is that let's liquidate them all because it's all in the corporation. So you liquidate them all, and then tomorrow you can repurchase the same portfolio. There is something called superficial loss. If you repurchase a portfolio with by realizing a loss, it wouldn't work. But we're crystallizing a gain, so this would not apply. And so if you recognize the gain, has the money to you have the money to pay the capital gain tax, that's fantastic because you can just repurchase the portfolio at the same price in a minute or in the next hour. That's with all of the stock portfolio. Now, but if you're talking about private shares that you own in some private equity and lend money, or you invest through your financial planner, some IPO stuff and early stage, those would be way harder to liquidate. Let's just be realistic. Now, if you talk about real estate portfolio, which is where I specialize in, it is even harder to liquidate because any transactions that, even if you list it today, May 2nd, it would be really hard for you to find a buyer that's willing to close before June 25th. You got to allow time. And one of the things that you could potentially do is to sell it between you and your spouse, or from your corporation to your personal name, or from your corporation to another corporation. Now, by doing this, remember, you have to get your bank's approval. And if depending on where your properties and investment properties are located, you might also need to trigger the land transfer tax. In Alberta doesn't have land transfer tax. That is usually not a concern. But in Ontario, and depending on where in Ontario you are in, if you own properties in Toronto, you would then also have to pay double land transfer tax on that transaction.
Wow. And
so the cost, if you think about it, it's so inefficient. It's not a productive thing to do what I just suggested. It's not at all. It's what good does it do to the society? Nothing. But then we have to do it because the government is making us do it. Now, there is a downside of something called general anti-avoidance rule. Essentially, if you intentionally do something to just avoid paying taxes, CRA can come back to challenge your transaction and deem that as a null, essentially didn't happen, and charge you full tax on it, or just not allowing you to do the entire transaction. On April 30th, a couple of days ago, I just realized CRA also think that accountants not busy enough on April 30th. They decided to release a bunch of information. And one of the things that they addressed was the crystallization of the capital gain before June 25th and whether this general anti-avoidance rule would apply. And they said generally it would not apply. So, I mean, you can take their word for it. They also have a caution saying that if you intentionally do it for the purpose of avoiding tax, we may still challenge it. So they said that generally it won't, but then it may still happen. So there is that risk. The legislation still hasn't come out yet. So we're still waiting to see.
So this is super confusing. Yeah. So yeah, there's always a way they can get you, right? You can outsmart them, but it's hey, sorry, you won this chess game. it's no, right? So they can always reset the rule. So, but the confusion is, when is this going to be legislated? So I heard from in a podcast, they say, hey, these announcements are not really law yet, right? Even the 2023 announcements were not fully legislatured, and 2022 as well, right? The different stages. And this announcement is needing to go through second and third reading. Yep. So what's the tax community, the tax experts like you guys, what do you feel? Is there a way that somebody can overturn this? Because there's a lot of hope that this would be overturned.
I know. I mean, it doesn't sound like it's going to be overturned. There's a lot of speculation, though. The speculation would be that because this capital gain inclusion rate affect many sections of the Income Tax Act. So for them to come up with something, it's not going to be easy. I think they did release something on April 30th. We just haven't got the time to really go through all the stuff that they released. What my understanding is that if the legislation doesn't come into effect, and there is an opportunity that it doesn't get passed and it doesn't get into the legislation in time before the next election, then the next person who come on, assuming that they are not liberals, will likely not continue with it. But then if they are still liberals, obviously this will still carry on. Nothing is going to change, right?
Right.
But that is the only case that this would not happen. Now, let's say they pass the legislation and now it's in effect, and elections call, because the election is supposed to happen by October of next year. It has to happen. It's just between now and October, it will happen, October 2025. Now, if the legislation had already passed, it would be, the tax community is speculating that it would not be overturned immediately because the money is already in the government's pocket. Right. They're looking at that budget and they're like, well, I'm not getting as much money. Why would I overturn it? I can always blame it to the previous government. So chances are, if it is passed, it will not be overturned immediately. But if it is not passed and the new government comes in, then there's a chance that we would not have it go on to become a legislation.
Right, but that's a bit of a gamble, right? If we say, okay, whatever, we'll just kick the can down the road and fix it later. Well, sorry, right? They may not change it. And even if they change it in next fiscal year, we're living in this fiscal year.
Absolutely.
Right. And then, so what about other nuances? Like it's not just about inclusion rates, right? Can we touch on other less publicized changes? For example, charitable donations.
Yes. So charitable donations, actually in 2023, they've announced the different ways of calculating alternative minimum tax. So for those of you who don't understand it, essentially it's just that CRA, the government came up with the way to tax you, to calculate your tax differently. Our tax is calculated in one way, but they realize that if you calculate it in this way, you may not pay as much tax. And therefore, they come up with the second calculation. It's called alternate minimum tax. And they put your information into that formula and make sure that that way of calculation, if your original way of calculation is less than the second way of calculating your tax, you would be paying at least the minimum tax, the second way of tax. Now, last year during the budget, they announced a revamp of that alternate minimum tax program. And one of the things that they give credit for is the donation, charitable donation. And now they've changed that charitable donation in the 2023 budget, essentially giving you less credit for donating money to the charity under the second way of calculation. Now, this is a huge deal in the charitable organization sector because they're expecting that because the government is taking away all the tax benefit from donation, and they would not get nearly as much, especially during the lifetime of someone giving. And in 2024's budget, they've heard enough from the charitable sector, and now they are dialing it back a little bit, but not 100%. So you're still seeing you are getting a better deduction in the alternative minimum tax calculation, in the new way of calculating it, but you are still not going back to the old way. So you're still not getting as much tax credit as in the past.
So the old way is what, 50% is a write-off, roughly?
Roughly, yeah. I think that under the alternative minimum tax, the really old way of calculation is 100%. And then in 2023, it became 50%. And now in 2024, it became 80%.
Right, that's where that 80 comes from. Okay.
Yeah.
Yes. So because there are lots of us say, hey, if I need to give the money to the government, I'd rather give it to a charity of my choice.
Mm-hmm.
Right. So now I heard one tax expert said that now the government says to the charitable society and said, sorry, I need the money, not you. Goodbye. Right. So those of us who believe in causes, well, tough, right? Tough. Okay. So what about real estate, right? This is real estate is your forte. Real estate is my passion. So are there any of these changes you already talked about the crystallization? What other things have impacted the real estate investment world?
Well, over the last few years, there were tons. The most notable one in the last half year, essentially since the fall economic update, was that they announced that if you are doing a purpose-built rental, you're now eligible to claim all the HST that you've paid to the government back, and to qualify for it, it has to be like start building day has to be after September, I believe it was September 14 or 23rd of 2023. And you need to be building 4 units and up. So it has to be 4 units and they have to be used for residential purpose. 90% of them has to be used in long-term residential purpose. And you would then be eligible to claim the HST that you've paid to the builders, to the developers, to the site planners, all of them back. Now, whereas if it doesn't fit any of these criteria, you would have to actually carve out money to pay to CRA on HST when the property is ready for occupancy by your tenants. So it's a huge delta in terms of how you're going to plan your building. Now, based on these type of rules, CRA also in the current year's budget in 2024 also offers something called accelerated capital cost allowance on this particular type of property. 4-unit purpose-built building, 4 units and up. It has to be started building after, I think, April 17. And you can now claim 10% of the building. Let me just double check here, making sure that I'm talking about the right thing. I do believe that it's 10%, and the construction has to be started after April 15, 2024. And
so 10% on the CCA, right? Instead of traditionally, what, 4%?
4%, yes.
Right. So that's a huge jump.
Yes. But the only thing I caution people is that, hey, this is CCA, which is depreciation. CCA, the way I explain it is that it's kind of like RSP. You claim it, you don't pay tax on whatever you claim. But the moment that you sell the property, all the year of capital cost allowance that you've claimed, you would have to bring it back to income. So kind of like RSP, you take money out, you have to pay tax on the RSP. So similar to that, it's a tax deferral thing. It's not really a tax write-off.
Yeah, but for people who are eating on so little cash flow, right, it's sometimes a deal make or break it, right? Yeah. Sure. What about short-term rental? Let's touch on that a little bit.
Exactly. So in the fall economic update in 2023, the government announced that they would disallow any write-off, all the write-offs. So traditionally, when you operate a rental, you're allowed to write off your mortgage expense. You're allowed to write off your utilities bill, property tax, insurance. These are like the usual stuff, repairs and maintenance. Now, if you're operating Airbnb, short-term rental, in an area that the local government does not allow you to operate it. So using Vancouver as an example, and using Toronto as an example, there are local rules, but local bylaws that prohibit people operating Airbnb. And if you're operating them illegally, you're not eligible to deduct any of the expenses. So essentially, you need to pay tax on the gross income that you receive. You may receive operating an Airbnb in Toronto, condo, you may receive $70,000, $80,000, $90,000 of rental income from Airbnb. But if they know that you're operating Airbnb, and I know that it is illegal, if you do have that as illegal, they would disallow all the expenses that you would normally incur to earn that business income.
Right. Just to clarify on that. So you tax based on the gross, not the net.
Yeah.
And even though you might be a foreign investor in a different province, or different place, right? But if your property is in those disallowed localities, Toronto, Vancouver, whatever, and the list is expanding, right? Then suddenly you got dinged.
Yeah. And then effective date was January 1st, 2024. And speaking of how late our government is, they haven't released the legislation. So whatever I said there was really just based on our reading of the actual fall economic update published on the government's website, the few paragraphs that they provided.
Right. Wow. Yeah. So again, I bring it up because A, this is your expertise and my passion, and B, I know that a lot of our listeners have some properties, right? Most professionals do. And of course, even if you're a recreational property, you sell it, you still get dinged by this capital gains, right? Even they say, I'm not a real estate investor, but if you have a recreational property, you have a condo for the kids, sorry, it's all going to be inclusive, right?
Yeah.
Right. Okay. So thank you for all that. Any quick highlights that pertain to us to kind of wake us up, a smack on the side of our head that you want to tell us about these recent changes that we should really open our eyes and up our antennas?
I think the government hasn't been really kind to us professionals, especially incorporated service professionals. I wouldn't say I would have any word of advice. A lot of people who really upset and affected by this situation have been starting to talk about leaving Canada altogether. It is sad to see that. And the funny part is I have a YouTube channel, and I was sharing with Dr. Lim before that this tax implication, I did a video on tax implication of leaving Canada. And that was done a while ago, like a couple of months ago. And then because of this recent budget change, that the views on this tax implication on leaving Canada video has shot up drastically. So yeah, it is really sad. The reality is though, the way that I advise my client is that if you are able to realize the capital gain, try to do it before June 25th. If you aren't able to realize it and you're not thinking of selling it in the next 2-3 years, you can choose to hold on to it. And at the end of the day, I like to end on a positive note. We're still doing well. We're Canadian, as bad as the economy is right now, we're still living in a great country.
Right. Yes. And thank you for that perspective, Sherry. And I would agree, right? So unless you are cashing all your chips in today, like I have a colleague that is literally retiring June 30th, right? And so this guy is a deep caca, right? So unless you're in that position where everything is capital gain inside a PC, right? Unless you're that kind of a guy that you need to talk to audit tax accountants, lawyers, everybody. You need everybody's help, planner, insurance guys, right? Unless you're that, we go through different ways, right? This is not the end of your road, right? So this end of the bump, right? So there are ways to navigate, there are ways to pivot, right? And if you're a long-term holder, like most of us anyways, we don't flip real estate for a living, right? And then there are ways, right? Then you can ride it out probably till the next change, right? Seasonal change. Yeah, so with that, I'm going to thank Sherry for your wisdom, your perspective, and your spending time with us. I know you're super busy. And if anyone wants to dive into her YouTube channel, it's highly entertaining and very simple. There's genius in simplicity, right? And so Sherry would just water it down to our intelligence level so we could just listen to it and digest and don't have to pretend that we know, right? So, and then I'm super excited, Sherry, that you're coming to Toronto. It's going to be super, super fun. She'll be here at the conference Saturday and Saturday afternoon. So to speak on 2 topics, and I'm super pumped, right? I'm just trying to put this thing together. I'm like the master chef, and I'm putting the menu together, and we have a plethora of great speakers and experts, and the synergy that they would create is like going to be amazing. So you guys who have signed up, you have a treat. Those of you who haven't, there's still time.
Thank you so much for listening to the Physician Empowerment Podcast. If you're ready to take those next steps in transforming your practice, finances, or personal well-being, then come and join us at phys.empowerment.ca PHYSempowerment.ca to learn more about how we can help. If today's episode resonated with you, I'd really appreciate it if you would share our podcast with a colleague or friend, and head over to Apple Podcasts to give us a 5-star rating and review. If you've got feedback, questions, or suggestions for future episode topics, we'd love to hear from you. If you want to join us and be interviewed and share some of your story, we'd absolutely love that as well. Please send me an email at kmilo@phisempowerment.ca. Thank you again for listening. Bye.